ערב טוב לכולם, קוראים לי גבי מוצקין ואני ראש המכון, וברשותכם אני אעבור לשפה האנגלית. Good evening everybody. My job is to open conferences. I do this all day long, but it's a special pleasure and privilege to open this one, because when I saw the topic, I could not refrain from wanting to chair this event, because I think it's so central and so important to all of us. And I always share with you an anecdote before I present the speaker, so I'll do this. When I was growing up, there was a strange currency called the escudo. I don't know how many of you remember the escudo. It was in a little country called Portugal, and it was supposed to be a very hard currency. And then I remember thinking, about the time I was 10 years old, why is it that the people are so poor in Portugal? Because if they have such a good currency, shouldn't they be rich? And as I thought about it, today I realized that we are in a world where the rentier class, the people who have money, do not want money to be devalued, because then they would have less. But economies that work out always have some kind, in the modern world, of moderately inflationary mechanism, so that they can partially monetize their debt. Because our countries run on debt. That's maybe bad, but that's the way it is, and it means that we can only do that if we slightly devalue the currency every year. Otherwise, we are going to go broke. That is why it is an especially privilege for us to have an evening on what basically is austerity. The reason is that some of us, I guess some of you, remember that we lived through an austerity in the early 50s. You remember the austerity we had here. But at the same time we had an austerity, you also remember the currency kept getting devalued. And so you had a very fast growth rate even though you had austerity. It's very odd. Well, having said all that, it's my pleasure to introduce Mark Blyth, who is a professor of international political economy at the Watson Institute for International Studies at Brown University. Now, I'm not going to read all of this. I'm just going to tell you that he's been a member of the Warwick Commission on International Financial Reform, and he's the author of books including Great Transformations, Economic Ideas and Institutional Change in the 20th Century, and a book that has not yet appeared, Amazon announces it for May 1st, called Austerity, The History of a Dangerous Idea. What we're going to do is he's first going to talk, then I'll introduce the commentators one by one, and I look forward to a fascinating evening. Mark, please.
Thank you very much for that introduction. I'm terrified to know that the book is on Amazon from May 1st, because I have a 5-month-old baby. And you can therefore guess that the book has not been written for the past 5 months, so something's going to have to give on that one. I thought we were on for a fall publication date. Thank you very much for inviting me here today. As you can hear from my accent, I'm from Scotland originally, which means one of two things. Obviously, Niall Ferguson was double booked. And, actually, the other great joke is, what do you call a Scotsman in a suit? The accused. So, we'll just move on from that one. Okay. If I walk around like this, can you hear it? Is this okay? Good. Because I hate being stuck by a microphone. God gave me a big voice, so I might as well use it. So, after the crisis, how to tell the forest from the trees when you're not out of the woods yet, or not yet out of the woods. Wonderful English expression. It ain't over until the fat lady sings. Now, why do I think this? Because whenever you see something that's over-explained and over-determined, you should be worried. There's a guy called Andrew Lin who runs the finance lab at MIT, and he just did a review article where he randomly selected 21 different books and papers on the financial crisis and found that he couldn't discern what caused it. There are so many things going on. You can simplify a little bit in terms of what people find popular, and they find them popular because it kind of goes along with the way they like to see the world. So subprime mortgages, Fannie and Freddie, this is the popular American right-wing version. We gave mortgages to poor people, and that's why the world blew up. Well, it might explain why American mortgages blew up, but it doesn't explain why the rest of the world was subsequently damaged. Complex instruments, mortgage-backed securities, CDOs, CDS, all those things we got a crash course in, nobody had heard of before. This is a kind of popular academic one. It's nice because you can blame the instruments without blaming people. So you don't actually have to really annoy anyone when you do that. It's all about the bad instruments, which runs into the obvious problem that, you know, there have been dozens and dozens of financial crises all over the world, and very few of them involved mortgage-backed securities. So, you know, it kind of fails the smell test on that one. Excessive leverage, regulators like this one because of the answer, if the cause was excessive leverage in the banks, then this gives the regulator something to do, because they obviously weren't doing much before the crisis. The inequality in credit story, this is the sort of popular left-wing version. Basically, we don't save because our wages have been squeezed and so on and so forth. And we get lots of credit cards to make up the difference, and that's all gone bang. That's true, but the timing's off. Basically, the rise in inequality happens before the expansion of credit. The Greenspan put, this is popular amongst bankers, basically, well, Alan kept giving us free money. What do you want me to do? I had free money. Well, how about you don't blow up the world with it? And then the last one, of course, which everyone can agree upon, is bankers are greedy. Well, bankers have always been greedy. You can't explain a variant with a constant. So obviously this is overdetermined. And it also is problematic because it seems to be with us in a new form. So here's a couple of pictures which I think encapsulates the current moment. As you can see, Bank of Greece scored out Berlin. So there's a little bit of tension going on there. And then, of course, the Occupy Wall Street movement, the claim of the 99% versus the 1%. And the crisis may have changed form in that we're no longer considering a banking crisis, we're worried about sovereign debt. But there's also this popular expression where this is popping up in very different parts of the world. This somehow seems to be connected. So I'm going to give you an explanation by metaphor. That is to say, there's a way of thinking about this which is useful. I'm not saying this is exactly what's going on, but it's a way of tying all of these disparate parts together. And it goes like this. Imagine the global economy as a subprime collateralized debt obligation. So those dodgy instruments that blew up the world, right? So the basic idea behind this was as follows. Mortgages are really safe investments. They really are. Most people pay off their mortgage. It just happens. Some people pay them off early. Banks don't like that, but just put that to one side. But most people pay them. But there are different risk premia. So for example, penthouse in Manhattan, probably going to pay it back, unless it's illicit. So that's safe. Then there's probably suburban Maryland, quite safe. And then there's giant glass-fronted condo in Baltimore, probably a bit more risky. So the idea was, if these housing markets were uncorrelated, if you put them together in a giant pool of bonds and then split them up according to their different risk profiles, you could take something that's already uncorrelated, that is to say, if the Manhattan penthouse goes bang, that doesn't necessarily impact Baltimore and vice versa. Then you make something that's super uncorrelated and therefore super safe, and you can sell different parts to different people. So it has this structure whereby you would have the super senior tranche, that's all of the really safe mortgages. And then you would have the mezzanine tranche, which would be a little bit more risky, and then the junior or equity tranche. And the idea behind that was, look, you're willing to take the risk for the high yield, that's fine. So people who are willing to bear the risk get the reward. And the idea was, if the red bit went bang, it doesn't impact the purple bit and it doesn't impact the green bit. Unfortunately, that didn't quite turn out to be true, because when you take half the world's money supply, or the functional equivalent thereof, and throw it all into the American real estate market, and you start to make what are called synthetic bonds, where you take the insurance policy income streams to replicate the bond so you can have an infinite supply, you create a giant correlation problem, because everything is related to everything else. So when the equity tranche started to go bad, the people in the purple tranche said, we could be next. So they freaked out and dumped their stuff, and then it went all the way to the senior, and that's one version as to how you got the crisis. Now, why is this like the global economy? Let's try this. Here's the equity tranche. It's called America. Let's start there with a whole bunch of dodgy mortgages and see what we get. So back in 2007, 2008, things started to go wrong. Now here's a fictional financial bust. This is not a true financial bust, but it has an interesting functional form. So if you have a look here, what you see is the dotted line is basically the trend growth of GDP. Everything is really, at the end of the day, determined by the trend growth of GDP, productivity perhaps, that's it. So you get these markets that bubble up and bubble down, but essentially they're meant to follow the trend growth of GDP. But what happens is you get this. A take-off phase. People begin to say, hey, this asset class is undervalued. Maybe we should buy this. Then you get into the first bear trap. People say, oh, it's overvalued, and they'll dump it. Then you get media attention. MSNBC jumps on it. Kramer has Mad Money or some other show. Suddenly it's a buy or a double buy. It's the dot-com mania where your entire pension's riding on one tech stock. Enthusiasm, greed, delusion. And when you get to the top, as soon as you hear the words new paradigm, run. And the smart money does, so you get the second bull trap. But then people say, no, no, it's really, really true. Everything has changed. The world is fundamentally different. And at that point, if you haven't shorted everything, you're about to die. Because then you go flying down through fear, capitulation to despair, and you end up returning to the mean where you started in the first place. Fictional, or the American housing market. Because if you put the two of them side by side, and you take out government support, it's exactly the same pattern, which is rather spooky. Now, when that bubble burst, all the liquidity in the world disappeared because none of the banks would lend each other money because they knew that they had on their books all the same garbage that everyone else had, so there's no way I'm throwing good money after bad by giving you money because you won't give me money. Consequently, no one has any money. When that happens, the stock market takes a hit. And although you see this bounce back that's happened just now, which I'll be happy to talk about in the Q&A, short version, there's nowhere else to put your money. That's why it's going back up. But the short version before that is you lose a decade's worth of appreciation in the moment of the crisis. Bad news if you were retiring or planning to retire in 2008. Why did this happen? This liquidity crunch. This is the iTrax CDS protection from the crisis from August 2008. Essentially, when you're very low, what you see is, I'm not really worried about risk. The first spike is layman. I'm really worried about risk. And then it goes up and continues to be high through 2008. The higher the spike, the more costly it is to get insurance on any type of financial bond. And the more costly it is, the less likely you are to hold it or issue it. So it becomes very hard to find prices for these on the sell side. That's why you get a liquidity crunch. This impacts the real economy. There's the American economy in terms of the recession that it had, much steeper than what it had in 2001, 2002. And unemployment rises. So when you listen to the United States unemployment figures, they talk about it being down now to about 7.9%, 8.1%. That's the red line. But the ILO compliant one is what's called U6, and that's discouraged workers, people who were on benefits, whose benefits have run out and do not show up on payroll again. If you include them, they're currently sitting at 15.1%. So the United States has 15% unemployment by any reasonable international standard, yet its stock market is booming again. That's a bit odd, isn't it? All of which, and this is where the 1% come in versus the 99%, reveals a rather different United States. One of falling savings and debt-driven consumption. The blue line are expenditures. The red line is the savings rate. It goes negative halfway through 2005. But at the same time, consumption's going up. Why? Mortgage, equity, line of credit. Home, equity, line of credit. Consumption, spending, through intertemporal smoothing. In other words, debt. Rising income inequality was very much part of the story, but that was disguised, because at the same time, if you had access to credit and you could maintain those expenditures, then you didn't need to fess up to the fact that what you were really seeing was an incredible skewing of the American income distribution, and the panel on the right shows that very, very dramatically. What you then see, looking at this, is falling median household income. So you see it begins to fall in the 2000s. It spikes up from 04 and then falls apart in 08. That's the housing bubble's effect on median household income. If you take out that spike, what you have is a linear trend which is going very much in the wrong direction. And then you have 46.2 million Americans living in poverty. Let's think about what the poverty line is. The poverty line in America is $22,315 for a family of 4. So what you have is a heck of a lot of people with very, very little income and very few people with an awful lot of income. That's where that 99% claim starts to come in. But it's only revealed in the bust. So it's bad times for everyone except the financial sector, because there you see the returns to relative education and relative wages goes down in the 50s, 60s, 70s and 80s. In other words, the middle classes do well. But what begins to happen in the 1980s? So where do the top banks recruit from? Harvard, Princeton, Yale, Columbia, on down. You get into one of those schools, you get extraordinary rewards. By 2006, 40% of the profits of the United States, corporate profits, were coming out of the financial sector, which is 10% of the economy. It was generating 20% of gross value added. It's 10% of the economy. Its productivity growth, if you measure it, measuring productivity statistics in the service sector is always extremely dodgy, was basically no greater than was in manufacturing, yet the rewards were completely outsized. Which rather changes the politics of governments bailing out banks. Because, of course, what happens is, here you have the fiscal balance of advanced economies. We get into a bit of trouble around the 2000s. We start to basically, on average, pull ourselves back down in terms of government debt, and then government debt explodes. Why is this? Well, because you're bailing the banks. Essentially, you have a choice. The choice faced in the United States, and I supported bailing the banks, was as follows. In the United States, if I remember my numbers correctly, there are 303 million people. There are 159 million people in the labour market. 72% of Americans live paycheck to paycheck. 60% of them can't get $3,000 together in 24 hours if their lives depended on it. And there are 55 million handguns. What do you think's going to happen if there's no money in the ATMs? So of course they build the banks. But when you bail the banks, what are you doing? When you add liquidity to the system, when you do a toxic asset investment, when you recapitalize a bank, you're taking private debt and putting it on the public balance sheet. That's what happened. It's a metamorphosis trick. You turn the private into the public and it's rechristened as sovereign debt. Suddenly this profligate state's been spending all this money, and they did, on the banks, not on anyone else. I take Amtrak in the morning. I would have noticed an orgy of public spending. Trust me, it didn't happen. But it did give us these folks, the Tea Party. My favourite one, of course, is the favourite one up there on the top left, which is keep your government hands off my Medicare. A fabulous mix up there. And then, of course, socialism, trickle-up poverty, etc., etc. Now, these folks actually do get something that is actually kind of important. The put's on them, because they bailed the banks. Ultimately, through taxes and lower growth and higher unemployment, they're going to pay for it. They may misidentify in terms of, well, therefore the solution is we need a big tax cut now because that will simply exacerbate the problem. But they're on to something. They know that this doesn't pass the sniff test. But they're also all terrified of future inflation because they're the middle class that does have savings, not the 72% that doesn't. And they're worried that if the government spends all this money, eventually it's going to come back into the system and there's going to be inflation, it's going to destroy their savings. And there you have the money supply of the United States. That's pretty terrifying on one level. I'm going to show you a slide at the end as to why it's not, but nonetheless, you can see where they're coming from. And that means, of course, that they're going to have to pay more taxes for basically paying up for paying out the banks, which is what that line represents. Now, all of this results in this nonsense, where suddenly America's drowning in debt. And the weird thing is, if you actually have a look at it, it's not true. US debt is in fact quite moderate. What you really need to look at is the composition of the debt. So let's think about the following. How many of you have a mortgage? Really? That few? This is fabulous. What a sensible country. There's a German saying on mortgages which I love, which is why rent from a landlord for 0% when you can rent from a bank for a positive interest rate? Kind of true. Anyway, if you did have a mortgage, your personal leverage ratio is probably about 3 to 1 or 4 to 1. Right? In terms of price to income, etc. If you're in an inflated area, it might be 7 to 1, but then your partner or wife or spouse, whatever, brings their money in, that's how you do it. And if you're a country like the United States leverage ratio, if you think about debt to equity, is 1 to 1. So it's okay for you to be 4 times as levered as the United States. The United States has the 6th Fleet nuclear weapons, the ability to print money, and tax-paying capacity. You don't have any of those, I don't think. You might, but no, you don't. European banks run leverage ratios of 55 to 1, which means a 2% turn against their assets makes them insolvent. Somehow we're panicking about government debt, which has the longest maturities, the lowest interest rates, and is actually regarded as the risk-free asset, whilst we allow banks to run on 2% equity. There's something wrong with this. If you want to be scared about someone, be scared about the United Kingdom. Why not add up all the debt that they have that's not government debt? Then compare that to the US government debt. Run screaming from the UK. I get to say that because I'm Scottish. Anyway.
What about France?
We'll keep it to the end. France is a lot healthier than you think. I'll explain why. Anyway, given all this, how did they do the swap? Well, basically they did the swap from the public to the private by turning the Federal Reserve into a bad bank. Well, why? Because no one in Congress can agree on anything. You have the Tea Party on one side, you have the Democratic Party that's basically run by the liberal wing of Wall Street on the other side. So how are they going to come to an agreement? Well, you don't. So Ben Bernanke comes in and says, just give me all the crappy assets. So this is what you begin to see. This is the Federal Reserve's balance sheet. So short-term repos, all these things called maiden lane, which is basically taking all the really crappiest mortgages and sticking it on the balance sheet of the central bank. Now, this is meant to be a temporary experience. Nope, it's still like that. That's what it looks like today. It's not getting any better. So if you want to know where the crappiest mortgages in the United States are, they're actually not in Citibank. They're sitting in Ben Bernanke's house. So this is how we've managed to turn private debt into public debt. Now, let's get to Europe. That was the junior tranche. Remember, go back to the CDO thing? Obvious, risky assets, they all went bad. But Europe's different, right? It's completely different. They didn't have dodgy mortgages, they didn't have subprime, all that sort of stuff, or so we thought. But now Europe seems to be in the midst of this huge sovereign debt crisis. So how do you get from one to the other? Well, how do you infect the mezzanine tranche from the equity tranche? It's true, Europe's not in great fiscal health. If you have a look at central government debt as a percentage of GDP, we know that the Greeks have definitely been at it. This is true. Put them to one side. The Italians, 10 years ago, their debt to GDP was 121%. Today it's 121%. The perception of the debt is what matters rather than anything else. Japan, of course, when you include their gross debt, is debt that they've sold to themselves and they don't actually, therefore are not vulnerable to runs on that debt, are the most indebted economy in the world. They get downgraded all the time by rating agencies and their short-term debt's still about the cheapest in the world, so it doesn't seem to work for them. And then you get to the middle of the pack, and it's true, European states carry higher debt. Why do they carry higher debt? Because they have higher intergenerational responsibilities. They have welfare states. Right? And they're also running high taxation regimes as it is. So they spend a lot, but they tax a lot at the same time, and they're able to carry a higher debt load. Or so we thought. Then what happens is current account imbalances, basically exports, imports problems. Have a look at the red line. This is Germany. This is why everyone drives a BMW. They're an export surplus. Have a look at everyone else around 2005. They're in deficit. So what you've got here is a kind of something that's a bit like the global situation between China and the United States. Because you have one country that's exporting and sucking in a lot of money and then recycling it through its banks. And where is it going? It's going back to the periphery. So you say, I'm married to a German, and I have a very nice, austere, in the original sense of the word, father-in-law. And he said to me, look, I'm a German, I'm a saver, I don't spend money on anything, so how come you keep blaming the German banks? And it's very simple. You take your nice savings and you give it to the bank, and the bank goes off and buys Greek debt. The people who control the current account are not the same people who control the capital account, which is why you got yourself into a whole hell of trouble. At which point he said, so I should take my money out of the bank. I'm like, no, don't do that one, but we'll just leave it there. Anyway, point being, you have this chronic imbalance in the Eurozone that's going on at the same time. Everyone else is in debt everyone else is in deficit relative to the German surplus. Now, are there lax public finances? Yes, of course there are. Let's have a look at the annual growth of government expenditure. Ireland is spending 12% a year as an increase. Spain is next, Greece is next, Portugal, and then you get down to the middle of the pack, which is more sustainable relative to the rate of growth. So how could they get away with this? How can you spend 12% a year, 7 years in a row? Where's the money coming from? Well, before we get to that, the usual story is it's about wages and competitiveness, and they're not competitive and all that sort of stuff. And it's true, if you look at the change in labour costs, have a look at Ireland. Ireland's 25% wages increase over a 7-year period? How on earth could they afford that? I mean, go back for 1 minute, right? They're basically spending 12% a year on the same period, an increase in public expenditure. And they're awarding themselves 25% wage increases. The Spanish are doing the same. The Italians are just as bad. Let's not even talk about Cyprus and Malta. Don't know why they're in there. Portugal, etc. But it's all the periphery countries. So what's going on with this? Net international investment position. Have a look at this. This is really fun. Germany has basically got 40% of its GDP going out of the country. Germany's really big. This is the big pile of German savings from my father-in-law, and look where they're going. Portugal, Spain, Greece, Ireland. So the banks are buying all that periphery debt. Why not? It's guaranteed by the ECB. The yields have gone down. This is awesome. If I buy enough of it, the spreads are very narrow, but it's a little bit positive, I can make a lot of money off of this. And it's safe, right? It's all great. So everything's fine. Which means that all the core banks are on the hook. So here's foreign banks' combined consolidated claims on Greece, Ireland, Italy, Portugal, and Spain. French banks are on the hook for 32% of GDP. That's where the French vulnerability comes from. Nothing to do with the French state. It's the French banks. Back about 2001, when the euro came in, French banks, Agricole, Banque Populaire, Normal, all the rest of them, SocGen, sat down and made a very rational calculation. All this periphery debt, we didn't call it then, European debt market, has lots of different prices. And this euro is going to come in. And when it comes in, we've already seen it in anticipation of the convergence criteria. The yield spreads, the interest rates that they need to pay get narrower and narrower. So once we're all issuing the same debt, it's kind of the same debt, and we've got this big shiny new thing called the European Central Bank. They're going to guarantee everything, right? So as a rational French banker, I think to myself, okay, how am I going to make money on this? Well, I can buy lots of it, spreads narrow, I'll still make some cash, but I can actually buy a huge amount of this. Because at the end of the day, I look at my balance sheet, and I say, yeah, the French state can pick that up. I mean, I'm Crédit Agricole, how big am I? So if I have 30% of my assets in toxic assets, the government will bail me out. I'm too big to fail. And that's true for every individual bank. What is it not true for? All the banks added together. So when we worry about France's AAA credit rating, you're not worried about France's ability to pay the bills or pay the pension to Marcel in Provence. You're worried about the ability to pay all of the banks off at once for the investment choices they've made. That's what the whole problem is. And when you see it that way, the sovereign debt crisis is not a sovereign debt crisis. It begins as a banking crisis and it continues as a banking crisis. But it's hidden in the sovereign debt markets. All of which gives us the euro problem. So the euro was great politics. Let's all get together and be Europeans. And the European political project was great. Anything at all that can bind the Germans, make the French play nice and rehabilitate the Greeks and the Spanish must be a good thing. Until they did it with money. Because if you think about it, one way of thinking about the European project was it was a series of very incomplete contracts. And if you have a kind of incomplete contract, like the type of thing that you'll have with, let's say, your accountant, right? You don't specify, most people don't, you don't specify every single thing your accountant will do. And over the years you build up some trust. And then your accountant says to you, hey, you know, Mark, you might be able to write off a little bit more if you do this. And you go, really? That's great. And I don't have to pay you an extra fee. Nah, it's fine, it's great. You build up trust through incomplete contracts. The problem with the euro is kind of a big, complete contract. You try to specify all the rules in advance. So what you're basically saying then, if you follow me with this, is we don't know what the future will bring. But if we have a set of rules that we all obey, then in a sense we can make the future operate within certain parameters. Wow, that's a very, very brave claim. Because what you're saying is you can basically decide what the future's going to be, so long as we all play by the same rules. Good luck with that one. Particularly when France and Germany were the first to violate the rules. So, other problems. It's not like the Fed. There's no real lender of last resort. They can throw liquidity at the markets, but it's not the same thing as the Fed can do. There's no unified bond market. We know this. You can't bail your own banks. France can't do it. It doesn't run the central bank. Why is British debt cheaper than French debt when the French economy is more productive and household debt is less? One reason is because they've still got the Bank of England. So in extremis, the Brits can turn on the money pump and can bail their banks. The French can't because the printing press is in Frankfurt. And that's why they're paying a higher premium for it. Bondholders, democracies, and bank runs. This is Greece. Eventually, someone in Greece is going to turn around and say, so let me get this straight. You want us to sit around for the next 8 years with 30% unemployment as the most talented people in the country reasonably leave. You want us to slash the public sector down to bare minimum. You want to throw already 1/3 of the country into poverty by the official measure. This is good for us, and at the end of it we get 120% of GDP, debt. Okay, here's an idea. Why don't you forget about it and we're going to defect? It's just a question of time. Which is the austerity problem. Why should workers pay for the mistakes of bankers? There's a paradox of thrift built into the whole thing here. Two statements sum up the austerity politics, and this is what the book I'm writing is all about. The following is absolutely true. You cannot cure debt with more debt. Absolutely true. Giving the Greeks another huge tranche of money is utterly pointless. Very simply put, you cannot solve a solvency problem with a liquidity instrument. You can basically keep throwing liquidity at it, but it will just burn up. Point number two, you cannot solve a fiscal problem, lack of a unified bond market, common fiscal framework, with a monetary instrument, the European Central Bank. It's just not going to work. So at the end of the day, you have a problem. Because while it's true that more debt can't cure debt, the following is also true. If everyone pays back debt at the same time, what happens? You shrink the economy. And Europe is now in a position where they're in a competitive shrinking game with each other to try and please the bond markets. But the problem is, the more you cut, the debt to GDP ratio goes up rather than goes down. Because you're paying out more in benefits, you're taking in less in taxes, and your economy is shrinking. It's self-defeating if it's all done at once, and that's precisely the point that they've reached. So what's individually rational is collectively disastrous. The solution at the end of all this, if it all worked out, the German solution, is somehow that the Eurozone as a whole is going to run a giant surplus against the rest of the world. I don't know how that's going to happen. Are we going to export to Mars or something like that? But if the idea is we all get super competitive and then we all export, well, the American consumer, as we've seen, is already strapped, and the Chinese economy, what we'll get to last, is 1/10 of the size of the European and American economies combined. It's not going to work. I'm in favour of tightening belts the minute we're all wearing the same pants. And the problem is we're not, particularly in the American context. So you get back to the politics of that. Cuts produce lower growth, not more, not less debt. And you end up with workers paying for the mistakes of bankers. There's the evidence that we've seen so far for the countries that have went through austerity programs. This is what's actually happened to their debts. They've gone up, not down. And the more they've cut, the more they've gone up rather than down. So, how did private mortgage debt become European public sovereign debt? This is the IMF's figures for how it all happened. And this pie chart tells you literally everything you need to know. The big blue area is revenue loss. So that's just about 50% of the total sums involved in bailing the banks globally. Half of it was making up for lost revenue, because the banks stopped paying bonuses, so you stopped collecting taxes, it hits the real economy, the economy slumps, you just basically throw these fiscal brakes in to try and stop the slide. Well, you're going to generate a lot more debt, so you're going to be paying more interest, which is the orange slice. Then you've got lending operations. This is the $1.2 trillion in loans that the Fed didn't talk about, that we only found out because of a Freedom of Information Act issue that was done by Bloomberg, of all people. Direct financial sector support is literally buying their crappy assets that you admit to publicly, because the stuff in the Fed isn't even really admitted to being on book. And all the terrible fiscal stimulus that the Tea Party get belted on about, 12% of the total. So 1/8 of it is actually direct government fiscal stimulus. 87% of it globally is the cost of bailing the banks. This is a bailout from the poor to the rich. I call this trickle-down class warfare. The transmission mechanism here is different. This is where it gets really funky, right? When the euro comes in, not only do you get this collapse in yields and then all these banks become overexposed and they bank on a bailout and all that sort of stuff, there's something else going on. You get this explosion in cross-border banking. Because when you're in the same area, currency area, it's not a question of if the German banks wanted to buy Spanish assets, they used to basically have to go through foreign exchange to do it. And then you would have foreign exchange risk on your books. But if it's all euros, you don't. So suddenly you can go in a spending spree across all of Europe. The problem is, what if different bits of Europe get into different degrees of trouble? Suddenly you've got different risk premia, but it's not exposed in the way that you're able to bank it because there's no foreign exchange risk, so there's no hedging. So suddenly you're massively exposed. Here's the really good bit. US dollar denominated assets of foreign banks total around $10 trillion. Here's what we just found out. Most of that's European. So let's step back for a minute. What am I claiming here? The assets that European banks have are dollar assets. So what are they made out of? Are they T-bills? Because we hear a lot about China. China's sitting on $3 trillion worth of, $3.4 trillion, $2.4 trillion of T-bills, you know, all this sort of stuff. But we're not doing that. So what exactly are these banks holding? Well, there's a guy called Shin at the IMF who figured this out. And I won't take you through all the tedious math, but here's a nice simple way of thinking about it. Go inside the box. US households give to US banks and US banks give to US borrowers. Ta-da, very simple banking system. But there's a thing called the shadow banking system that exists on the periphery. The wholesale funding markets, and then on the other side, the shadow banking system, which includes the repo markets and all that sort of stuff. What does it basically mean? US households are also opening money market accounts. Those money market accounts are going to money market funds. European global banks, particularly those with what are called broker-dealer licenses, are able to borrow in America on those wholesale funding markets, the money markets, because it's really cheap. And it's overnight, and you can keep rolling it. And then you can basically loan out a 30-year mortgage based on overnight lending. That was the banking model. And how were they doing this? Well, they were taking the money and lending it to domestic consumers and loans, all that sort of stuff. But what they were also doing is they were buying American assets. They were going into the shadow banking system and buying American assets. Well, what were the assets that they were buying? Well, have a look at the second line. Eurobanks take a bath on US asset-backed commercial paper. 70% of SIVs are European. What does that mean? They bought all the crappy mortgages that's not in the Fed. So we heard about the Landesbanks in Germany getting into trouble. Oh, those silly Germans, idiots from Dusseldorf. No, everyone was at it. 70% of these special investment vehicles designed to pump and dump mortgages belong to European, not American banks. And it's still on the books. That's the dirty little secret we don't want to talk about. Now, if you go back here for a minute, back to this one, that wholesale funding market, 6 months ago they stopped lending to the European banks. So what did the European banks have to do? They went to the ECB and said, you need to give us lots of money, and you need to give us lots of money right now. Hence the $1.5 trillion in emergency lending that was given out in December last year. Eurobanks list their periphery debt as Tier 1 capital under Basel. That's hilarious. The most risky assets are your 2% safety valve for your 50 times leverage. You can't be bailed by your own governments because you're too big to bail and you don't run the printing presses. And you're on life support from the ECB. So, that's your mezzanine tranche. In trouble. What about the Chinese? They're doing all right, aren't they? They're awesome. They're the fastest growth rate in the world, all that sort of good stuff. And if you have a look at Pudong, they're the financial sector of China, which is, if you've ever been to Shanghai, you can stand on the Bund, which is kind of an interesting historical irony. The Bund was the bit in Shanghai where only the Westerners could walk under the colonial agreements that they had. And then you get to look out at what was a paddy field, which is now filled with all these fabulous high-tech buildings, which are all banks. Here's the irony. Apart from the People's Bank of China, they're all foreign banks. Why? Because the Chinese government doesn't trust its own banking system. So when it takes in the money from Walmart, it sterilizes it by cashing it with Citibank, who then use it on their behalf to buy T-bills. So it stops at the border and then they issue their own domestic credit. That domestic credit, the Chinese public get. They don't actually trust their banking system either. What do? They buy real estate. Oh, that sounds familiar. China's assets and liabilities, 3.4 trillion in US debt and cash. Pretty good. Economy growing at 10%. Great. World's second largest economy. Brilliant. 400 million people out of poverty in 20 years. Rock on. Liabilities, 35% consumption. Whoa. Average for the OECD is about 65%. The US is 78%, actually 72%. Britain, of course, where basically everyone just shops. As far as I can figure out, the whole of the British economy, really, do you remember Napoleon once said that they were a nation of shopkeepers? They are. I mean, it's really true. They actually they shop. That's all that they do. There doesn't seem to be anything else going on. In China, unfortunately, nobody shops. There's 35% consumption. This makes the Germans look like spendthrifts. They have 38% national savings. In 2005, the US was negative. That should tell us something. Domestic housing bubble, hugely levered domestic banks, large-scale domestic unrest, 100,000 major protest events a year. The Gini at 0.47 in a measure of inequality, basically perfect inequality, equality was 0 to 1, and they're the same as the US, with absolutely no safety net. This could be quite volatile, but the killer is this one. EU and US is 70% of global consumption, China's 10% tops, and that's being generous. It's really about 10% when you control for national savings effect on consumption. So take home, don't expect the senior tranche to survive if the equity and mezzanine tranches implode. And what would actually make this happen? Well, the first obvious one is probably continuing European sadomonetrism, as I like to call it. as we all try and slash our way to growth simultaneously, which again, I don't really have a problem with this. It does work if one country does it and everyone else is growing, right? It works. There is actually a thing called growth-friendly fiscal consolidation. It's happened to 2 countries in the OECD in the past 25 years. Everywhere else has been a disaster, and it's a disaster now because everyone's cutting at the same time. It's a logical fallacy. It can't work. But we'll keep doing it. My favourite moment of idiocy from the past couple of weeks was when Angela Merkel got up and said, "We realise that austerity alone is insufficient. We also need structural reform." Which is a bit like saying, I realise that bloodletting isn't enough. What we're going to do is beat the crap out of the prisoner as well. Because there's no such thing as expansionary structural reform. When you're in a recession and you make it easier for employers to hire and fire, do you think they're going to hire or fire? The payoff is convex in one direction, to use the language of finance. It doesn't work like that. A pig's default. It's just a question of time. Greece is insolvent. You can throw as much liquidity as you want. You're kicking the can down the road. They have no assets with which to grow again. They don't. Their banking system is broke completely. It's been on life support for over 2 years. They have shipping, but shipping is a bit like Liberia. Liberia has shipping as well. We don't think of Liberia as a giant country. It doesn't create many jobs. It doesn't create a lot of GDP, and basically it's a way of passing money through around the world. It's basically a giant money laundering scheme. That's what international shipping is. What else do they have? They have olive oil. That's true. So does Italy. So if they get really competitive in olive oil, they can make Italians unemployed. That really works, right? What else do they have? They have beaches. They have beaches and an uncompetitive currency that they can't devalue. Consequently, which country around them has been making out like bandits on tourism because they're not in the euro? Turkey. Nobody goes on holiday to Greece, everybody goes on holiday to Turkey. Why? Because it's half the price because they're not in the euro. So you can slash wages by 50% and it still won't make you as cheap as Turkey. They're not coming back. Eventually someone will turn around and say, enough, we're not doing this anymore. Or the last one, of course, a large euro bank collapses, which is entirely possible, which is why the French story is interesting, because they have some of the most at-risk banks. The Germans have as many at-risk banks, but they also have bigger financial reserves to deal with it. And ultimately, they're the ones who really run the printing presses. But there's another deeper problem, and we'll close with this. As you can see, I'm really upbeat. I like to accentuate the positive. What if the underlying business model of global finance is dead? Here's what I mean by this. As I told you, I was totally in favour of the bank bailouts because, 55 million handguns, 150-odd million people, 159 million people, ATMs, blah, blah, blah. Not a good idea. But what if it's all been for nothing? I mean, really, what if it's dead? Because the idea is, right, we're particularly United States, United Kingdom, finance-led capitalism. It's actually a growth model, much in the same way as cancer is a growth model, in my opinion, but there you go. But anyway, there's a growth model, so what we need to do is we need to pump the liquidity back in, and then everything will be okay, and then they'll come back, and they'll make bonuses, and we'll get taxes, and we'll be able to fund things again. Maybe not. If you go back to, let's say, 1947 to 1977, banking used to be known as 363 banking. I couldn't get a graphic for this. I could only get one for 347 banking. But the idea is the same. You borrow at 3, you lend at 4, and then you earn 7. But actually, really the way it was you borrow at 3, you lend at 6, you're on the golf course for 3. That was the way it was meant to be. Then you deregulate. Suddenly you can take on leverage, you can start to invent nice instruments, you can trade with each other, you don't need counter customers anymore, they don't earn you enough money, you need counterparties, so you get the growth of giant banks. We also started to do things like privatise pensions, and when you privatise pensions, suddenly not only do you have a huge amount of money looking for yield, investment, you demand, in a sense, the growth of institutions, institutional investors, to start investing this money. So you get the whole global hunt for yield that goes on. Now, what does this do? The new model that was built upon this is counterparties, not customers. Other banks. You make 60% of your profits trading with other banks. You don't make it off of me and you opening a deposit. In fact, the deposits that you register aren't even real deposits. What else is that? Fat trading books. Lots and lots of trades. You might only make this much on a trade, so do 1 million of them. Keep it going. And the last one is huge amounts of leverage, either through debt to equity or through using complex instruments, derivatives. Why would you buy shares and expect them to go up when you can have options to buy the shares, which are much cheaper, and then you can amplify the spread and amplify the bet? Out of the money options as cover, why not write credit default swap protection? What a brilliant invention. Basically, what's the chances that Lehman Brothers will ever go bankrupt? I mean, they've been around for 138 years, so I'm totally willing to write a contract that says, if you borrow X from Lehman, I'll insure you for the full amount. They're not going to go bust. They're too big to fail until they're not. So you add all this together and you have free public insurance, because ultimately if you are too big to fail, you and I need to pay. That was a business model. It's called extortion in normal circles. Now, in order to make this work, you need underpriced assets as fuel for the cycle. From 87 to 2007, you had equities currently held up by lots of repos and super cheap money, and the fact that there's nowhere else to put your money apart from American equities. Would you buy European bank stocks, for example? I don't think so. Real estate, underwater for a generation now, probably after being humped and dumped all the way through the 1990s and up to the bust. And finally, commodities. Remember before the financial crisis, there was that weird moment when a commodity markets just went completely nuts? And rice was trading at 80% of its historic value, and gas went up to 147 and went down to 35. I had a great exchange with John Dizzard in the FT about this. He wrote me a very, very rude email saying I was a bit of a fool, put it that way, because I dared to point out that really Chinese demand, I don't think China's actually importing 5 times as much gas this year as it was last year. You know, that's not really the demand factor that's doing this. It's called speculation. So, a little bit of a look at this. If you have a look at US and global stock markets over that period, you see a very interesting trend. Remember the very first bubble that I showed you had that dotted line, which is the trend rate of growth of GDP? Well, your stock market's meant to look like that. It's basically nothing more than an index of the rate of growth of the economy. The green line is Japan. This is the future we want to avoid. If you go back there, what you see is the busting of the Japanese real estate bubble, followed by periods where they decided to spend money, and then periods where they got freaked out and decided to cut. And you end up all the way down here. It's called 15 years of recession. Have a look at the red line. That's the British stock market. It does just what the Americans do, only in a smaller version. Just like everything, really, when you think about it. And sycophants? Never. Anyway, if you have a look at that, you'll find that the underlying rate of growth of the British economy is about 2.2% a year. That rate of growth there on that index is about 4.4% a year. So it's twice the rate of growth of the economy. If you have a look at the American stock market up to its historic high of 14.4 just before the crash, what you find is a rate of growth of about 7.7% a year on a 3.3. That's a bubble of 20 years. Housing. Ireland's my favourite example. They only managed to inflate to 180%. Look at the damage that that did to their economy. But everyone was at it. Spain's up there. Australia, which still hasn't popped because basically they're a proxy for the Chinese currency. And so long as they keep buying commodities, they're fine. But Netherlands, everyone has this huge housing bubble that begins to deflate now. And there's that commodity spike. Oil and gold. Oil pops and starts to go up again. Gold continues to rise. Why? That inflation fear that's there. So you put them all together, that's the history of the past. We lived through 3 gigantic asset bubbles that have all gone bang, and they're not going to come back because equities are overvalued, real estate is underwater, and commodities are too small to play these games. The markets cannot contain the volume of money. So what are we going to do to restart the cycle? Well, you're probably not. What if the growth of finance was the bubble itself? I mean, is it normal to think that you can go back to 40% of US corporate profits coming out of 10% of the economy? In 1977, Morgan Stanley had 250 employees. Today they have 62,500. They're a bank, but 70% of their money is made trading with other banks. Trading is zero sum. Somebody is losing, nobody is gaining. It's completely flat, it nets out. 31% of MIT grads went into finance. They're not engineering our way out of global warming. They're engineering more and more complex ways to play trades with each other. The return on capital in finance is twice that of other sectors, and this is the debt burden you're left with. Student loan, $500 billion. HELOCs, $500 billion. Credit cards, $1 trillion. Mortgages, the same as American national debt. And I will back the United States government's creditworthiness over a homeowner any day of the week. But you've got 46 million consumers on less than 22,314 a year, and they're all paying back debt now. So can you really expect this to go back to where we were before? No more underpriced assets to pump and dump, ongoing public and private deleveraging. The Japanese future may be ours. Shrinking bank footprint. There's another reason. Those regulations that we put on them, the interproprietary trading, the Volcker rule, all this sort of stuff, no more big bonuses, it increased their fixed costs. And if their fixed costs go up at the same time as their leverage ratios go down, they cannot earn as much money, even in an ideal environment. So the banking sector is going to shrink one way or the other. It's not going to be Zuccotti Park and Occupy Wall Street that does in the banks. It's going to be market forces. And there's something poetic about that. We still have a problem of chronically low wages for 40% of the income distribution in the US and in the UK and in the European environment. The difference is that that unemployment is concentrated in youth unemployment. So it's very, very high and the wage is chronically low. And ultimately we figured out that banks are writing checks on us and they're not going to get to do it anymore. So they're not going to have free public insurance, which means the real risks of their investment will be borne by the banks themselves. And if that's the case, you can expect that their balance sheets will sink significantly as we go forward. So the take-home is this. If you think about it, the global economy looks a lot like a vintage 2007 subprime CDO. The equity tranche was a bunch of dodgy American mortgages that went bang. That created the need to bail the banks. By bailing the banks, you impact the balance sheets of sovereigns. Those sovereigns are actually not in sovereign debt crisis. They're still dealing with the fallout from the banks. The way that we're trying to fix this is by rehabilitating the very banking model which has failed, and it might not come back itself. The junior has infected the mezzanine. The senior tranche is not secure. The crisis begins and ends with the banks. The sovereign debt crisis is a transmuted banking crisis, but for some reason we still beat up on sovereigns, which is a very odd thing to do. Which is why the road out of the forest, even if you can see it for the trees, is not so straight. Thank you.
Thank you for a really engrossing and absorbing talk. And now we're going to have two comments. And the first will be by Reuben Gronau, who's Professor Emeritus at the Department of Economics at the Hebrew University, and is also a Fellow of the National Bureau of Economic Research. And since 2011, he is a member of the Bank of Israel's Monetary Committee. So this is just the person who should react.
Well, I have to start with a lengthy apology. For once, I don't represent the Bank of Israel here. Actually, I'm an oddball on the team of the Monetary Committee, being a microeconomist and not a macroeconomist, and having doubts about macroeconomics for the last 40 years. The reason I'm here is because Moshe Yustman asked me to comment on the reform in the electricity industry in Israel. And I told him I'm not up to date on the reform, so he said, all right, so why don't you comment on Mark Blyth's talk? I couldn't reject him twice, so I said, all right, I haven't much to say. He said, no problem, and then he went to Australia. So I'm stuck here with a very short story, but since competition is always healthy for the economic environment, I brought quite a few pictures. So my story consists more of pictures than it consists of words. So the question is, when are we going to be out of this forest? Is there a way out of the woods? And the truth is that right now we can see a lot of trees, but it's not clear that we can see the whole forest, as you have mentioned, and we don't really know what's the best way out of the thicket. So actually Googling my way out of the woods, the first thing which pumped up was this week's cover of The Economist, which is the one which you have here on the slide, which shows that great minds think in the same way. So we have a problem, how to get out of here. But the problem is not novel. Of course, we are familiar with the Rogoff-Reinhardt analysis of the last 200, 400 years, but I prefer to bring in the data from a paper written by Bordeaux and Eichengreen and some co-authors, Is the Crisis Problem Growing More Severe? I brought this paper because it was written in 2001, way ahead of this crisis, and they were analyzing also about 100 years of history, and let me read the conclusions. The questions were, are crises growing more frequent? Are they becoming more disruptive? Are economies taking longer to recover? And what they find is that crisis frequency since 1973 has doubled and rivaled only by the crisis-ridden period of 1920 and 1930. And the explanation for the growing frequency and chronic cost of crisis focuses on the combination of capital mobility and financial safety net, which encourages banks and corporations to accumulate excessive foreign currency exposure. So actually there's nothing new in the story. The story has been told before, the lessons have been learned. So are crises more frequent? This is the picture which they show, namely going from the starting in the 1880s, going to 1997, and as you can see, crises have been becoming more frequent, in particular after sort of a period of 45 to 71, which was almost crisis-free, where the only crisis which existed were currency crises, but there was no banking crisis because everyone was under the Bretton Woods arrangement. But since 73, when this arrangement collapsed, we have more and more banking crises or twin crises coming up, and of course the 70s and 90s were the most periods where these were the most frequent. There is an increased frequency of crisis. The currency crisis become more pervasive than are more pervasive than a banking crisis up to that period. There are a lot of spillovers from one sort of crisis to the other, and the crisis, according to their experience, was more pervasive in the emerging market. They were thinking about Indonesia, about Malaysia, about Korea. They were not looking much what is happening under the nose. Are they becoming more disruptive? I don't know whether you can see the figures, but what they show is that the number of years it takes to get out of the crisis, when you have a currency crisis, is about 2 years, but when you have a banking crisis, it'll take you 3 years, and when you have twin crises, it may take you 4 years. Also, the loss of GDP becomes more severe when you have a banking crisis. It's about 7% of GDP, compared with 4% when you have a currency crisis. God forbid you have both, you lose 16%, and the losses are growing over time, with the exception, of course, of the big crisis of the Big Depression in the 30s. So, finally, the last lesson they are taking out from this experience is that the worst that can happen is liquidity support. When governments or central banks support the banks, the crises become much more disruptive, as you can see when you compare the black columns with the white ones. So let me read what they say at the end of the paper, bringing an example. The credit boom channeled substantial investment into real property, creating an asset price bubble. When the bubble burst, a number of lightly regulated finance companies that were heavily involved in real estate immediately encountered difficulties. Initially, the government avoided acknowledging the problem by extending massive liquidity to these finance companies in the amount of 10% of GDP, By mid-1997, however, the manifest insolvency of this institution compelled authorities to close all but two of the intervened ones. Additional low-cost government-supplied liquidity, which was provided without intervening in these companies' operation, only added to the supply of funds, etc., etc. Now, this sounds familiar, but the date is wrong. It's 1997, it's not 2007, and the story is the story of Thailand and not the story of the United States. But if they would have written it in 2009, this paper, they could have used the same sentences. So the story is the old story. We have a financial crisis, we have a drainage of liquidity, we have an expensive monetary policy, we may run into a liquidity trap where we run into zero interest rates, and the question is how can we pump money into the economy, and then we may have the risk of a run on the bank. The central bank has to play a secondary role as a banker of last resort, and the question is the central bank capable of fighting on both fronts? What is new about this story? So this new part about it is the role of government, at least in the Western world, because we had the governments rescuing banks, but these were retarded. This was Thailand, this was Malaysia, this was Indonesia, this was the IMF forcing the government to intervene. We didn't have it in the Western world, in developed countries. And here, government is called to save the banks. The problem is the cost of the rescue mission, because much of the available public expenditure were, as you have said, pumped into the banks, and relatively little resources were left for real activity. And the question was, whom should we have saved? Should we have saved the bankers or should we have saved the homeowners? There are externalities which the takeover of bad debt in the real estate market has. You watch on television, you see devastated areas all over the United States because of homeowners leaving their homes. And perhaps it should have been aimed at the homeowners paying back the banks, and it would have been much cheaper. So now we are facing the dilemma of an increased budget deficit and the increased cost of debt. And as long as we have a low debt to debt to GNP rate, we can borrow almost at a constant rate at R0. This, of course, has given out. But once we go beyond a certain level, at D0, the price starts going up. And not only are we paying more on the new debt, we have to pay more on the existing debt. And at some point, the increase in the budget deficit is swallowed up just by increased debt payments. So what are the lessons? For once, you have depleted much of your ammunition, so you have to save every bullet. For once, the expenditures have to be very selective. The increase in expenditures have to be very selective. And I'm not telling it to the European, I say it here in Israel. Because the question is, should we spend more on current expenditures or should we spend more on government investment? And my answer is, put it in investment, but be very careful in selecting your investment. You have to minimize the political rebates. In Israel, when you spend a shekel, 20 or 10 shekels, 2 shekels will go for defense, and another shekel or 2 will go for, well, everyone can guess where it goes, for political bribes. So you have only 6 shekel left. So you have to minimize this tax, and you have to be very selective in the investment program. It should be infrastructure and human capital, but it's not clear that a railroad to Eilat will do the trick. So these are the lessons which, as a bystander, I take from the story. And the most important part of it is leadership. The question is, are there enough adults around to take us out of the wood? And as an economist, I can tap myself on the shoulder that at least 2 of these countries have chosen economists as their prime ministers, increasing credibility of their policy. So what is the shape going to be? I'm not sure it's going to be a straight trail. It may be a little crooked, and there may be a very narrow one and winding, but as the economist says, Europe is on the road of recovery, but the way is long and dark. Thank you.
Thank you. We will now have another comment, and this is Dr. Tal Sadeh, who is the head of the Harold Hartog School of Government and Policy and a senior lecturer at the Department of Political Science of Tel Aviv University. And his main research interests are international political economy and the political economy of the EU, which is a rare bird in this country. So, Dr. Sadeh.
Well, certainly we are discussing things that keep turning up along human history, and we are sort of repeating ourselves, but I think we're mostly interested in the most severe storms, right? Boom and bust is part of life, but when they come close to killing you, you pay more attention. And so, with all due respect to Thailand, of course, and to Israel and other places who have suffered booms and busts, bubbles, and reckoning times, I think the special interest that we have in what has been happening since 2007 and 8 has to do with the magnitude of the things and the worry that since the big powers are involved and they're out of money, then who's going to save the system, which is something you alluded to at the end. I'd like to start with my last slide, actually. It just follows on what we've seen here. What you have here, I'll turn it into show mode. There we go. No, there's this button you push. There we go. So, Mark, I apologize for the Hebrew notation down there. It's just taken from a different slideshow where I prepared this. What you see is you've got 3 lines here, obviously. The black line on the top is NASDAQ, starting from August 2000 and going for 33 months until May 2003. The green line is NASDAQ, starting at October 2007 and running 33 months until July 2010. And the red line is Dow Jones, starting at August 1929 and going for 33 months. Why 33 months? Because back in 1933, when Roosevelt came into office, he stopped the rot after 33 months. So the red line is what it looks like when you do Hoover. That is, when you don't do it. And the green line shows you that we were basically doing the same thing until Obama came into the office, right? More or less. Or just a bit before he did. Sometimes there's a shadow of what's coming to be that affects the market. It just goes to show that the recent crisis had all the potential to be as bad as what we had in the 1930s, but the policy story was different because we learned something, right? But it also may, coming from the political economy wing of things, it can also be understood to suggest that actually left-wingers are the best friends of the bankers. which means you only get better in finance when there's a left-wing government because they don't have an issue with moral hazard. Or they do, but they always trump it in favor of systemic risk. So, having said that, I'll go all the way back to what I prepared. Now, I'm also writing a book. My kids are, the youngest is now 12, so I don't have excuses about this. This is a book about what's been happening to the euro, and as the title suggests, I don't know how many of you are familiar with the history of monetary integration in Europe, but they had a flirt with a single, or with a thought of having a single currency in the 1970s. It didn't work very well because of the inability to reconcile domestic politics in Germany and perhaps culture with that in the rest of some of the important countries in Europe at least, and it fell apart pretty soon. It was called the snake. The snake was characterized by a core and a periphery. And its cousin, the EMS, in the 1980s was a more sophisticated and elaborate thing, but as with instruments, it only served to obscure the reality that there was a core and a periphery. The big thing about having a single currency, or one of them, was that we're doing away with the periphery. We're all core, right? All the way down to the IGN, it's all core, no more periphery, right? But the argument of the book is that it's back. And it's back in a number of ways that I will try to convince you. Now, I've prepared this. I got so excited about what I want to say, and I prepared all these 42-something slides, which, of course, I have no time to show to you, so I'm just going to walk you through some of the more important issues. I was here 2 months ago. Barry Eichengreen gave a talk about the euro. Danny Zidon, Leo Lederman were here. They were really upset about the ECB not performing the role of a lender of last resort. How can you have a currency without a lender of last resort? Well, the good news is that there is a lender of last resort, especially since that very month, December, things took a turn right there and then. But even, and I'll show this to you today, much before that. In fact, the ECB is a lender of last resort, which, with all due respect to German concerns, is a good thing for the core. It's something good to preserve the single currency. It's a softening of the rules from the point of view of the Germans, but it's a hardening of the core for the sake of the institutional preservation of this currency. But down there, south, the periphery is falling apart, and so there's no more pretense that you enter the euro for good. It's not a one-way ticket. You can actually be booted out. Yes, as Eichengreen keeps saying, it's catastrophic, but as I will show you, Greece is undergoing a Hoover-like depression. They're really being killed there. Okay, so we had the first round of bailouts, and I'm skipping the story. In a way, my talk comes on top of yours. It's sort of follow-up because you made some comments about what's been happening more lately, but most of the data and the graphs stopped somewhere at 2009. So this is sort of a follow-up. In a way, you can say, indeed, the bubble keeps going from one place to the other, right? We first had, in recent times, we first had this bubble in .com, then it became a bubble in real estate, then Europe was a bubble, then commodities were a bubble, then China is a bubble. So the bubble is with us. It just keeps moving from one place to the other. Now, one argument is to suggest that you always have to live with inflation. The only question is, will it be inflation in goods and services or inflation in assets? But when you live in a market economy, there's one into the other, and if you follow the Reinhardt and Rogoff logic, it's just two different ways of doing away with debt. You either inflate the debt away, or you fool investors into thinking that you've conquered inflation, and then all of a sudden, when they're not alert, you hit them with a simply official default. You know what? I'm not paying. Okay, so the story starts, from my point of view now, starts at 2010. We have a first round of bailouts. Bailouts, reminding you, were not supposed to happen in the euro. There was, they had this Bible, it's called the Maastricht Treaty. It says, thou shalt not bail out countries. That is, everyone pays their way, and if they have debts, they have to repay them, and there's no debt forgiveness, and they should not expect to be bailed out. Now, one way to explain this provision was that it was a way to try and prise open German fists and let their Deutschmark go away. There was the only way that Helmut Kohl would have passed the euro in Europe, in Germany, was to tell the Germans that the euro is going to be just like the Deutschmark. And here we have all these rules. But right after they approved it, and in 1999 the euro was launched, Germany was, as we know, one of the main violators. So they didn't really mean that there will be no bailouts. Okay. So when Greece is in trouble because it has used, what's this? Quit. Steve Jobs still interrupts everyone now. Then would you like to buy my stuff? Greece went into trouble because it used the good times to borrow heavily. When the good times, that is the bubble, all that money from Wall Street, all that money market, the money funds, all that money dried up, then all of a sudden they were deep in debt. And clearly they needed help. But immediately there was a dynamic of a vicious cycle, right? So the Greeks are used to be heavily employed, about a fifth of them, in the public sector. They're used to a patronage system. They're used to a system where you get a job not only by your qualification, but to a great extent by your political affiliation, your family relations. This is not really special to Greece. Most of humanity lives like this, right? The places where you get a job just because you are the best qualified person are actually the minority of places. Most of the places are about ties, okay? But Greece was in the euro with Germany, and that made it different. Not only in Greece, but also in Portugal and in other places. Mark already discussed why Greece was different, the issues of what do they sell. But look at Ireland. Ireland also needed a bailout. That was a different kind of a bailout. The Irish are competitive. They are very open. They're very serious and globalized people. But they overdid it with banks. Why did they do that? Because they used to be recipients of aid, and the Eastern Europeans took that money away from them, and it took them time to reinvent themselves. And in the meantime, they piled up a big banking sector. It was oversized on the country. So their bailout is more of a happy story. Again, they're not totally out of the woods, but basically there is no vicious cycle there. It was vicious, but not in a cycle way, and they're growing out of it. So I'll skip that too, and I'm going to come to Portugal. That's the third bailout, and that was a preemptive bailout. Portugal didn't come to the brink where it was about to collapse. It just looked like a repeating story that they'd already seen, and the European leaders have learned a lesson. Why don't you preempt this, right? We've already established that we do bailouts. So there's no rule breaking anymore. It's done, right? And we know where it's going, so why not do it cheaper now instead of letting the problem fester and pay a lot more later, okay? Where does it take Portugal? We got vicious cycle there. On a slow motion, Portugal is living like in a bad dream. It has the same trajectory as Greece, only on a much slower pace. So that's like a nightmare you have. We're going there. We're past the event horizon, as physicists say. This is going into the black hole, but we're doing it really slow for now. So it looks like they may need a second bailout. I'm going to skip this and go and discuss the Greek collapse leading up to the July 2011 second bailout, which, by the way, they haven't received a penny yet. Right? It was just a promise to help them, but it was so much based on conditions that the Greek has so far seen none of the money. In fact, the first bailout from May 2010, the last payment was just delivered recently in November after using it as financial gunpoint to force them into reforms that they were so reluctant to do. Now, the problem, this Greece 2.0 is a problem because it really was hooked into the problems you discussed earlier, which means a lot of banks in Europe are holding Greek debt. It became a systemic risk. Greece was, in a way, much like Bear Stearns in March 2008. They were small, but they were too entangled to fail. That is, if they failed, they would set out a chain reaction that would consume a lot of big banks and a lot of big countries. And you've got some numbers of exposure of German banks to the bailed out economies and French banks, and this is not small money. And if you think in terms of a domino effect, where does it all lead? Then from Athens it leads to Portugal, into Spain, into Italy, and right into Paris. Okay? So if Italy goes, that's a fifth of the French economy that's exposed. So clearly they're very interdependent, and this is something they need to resolve together. Greece has a lot of problems in following the reforms that they're asked to do. Maybe it's a matter of mentality. Maybe it's a matter of the politics of Greece. I remind you that Greece, Portugal, and Spain are young democracies. It's not too long ago that they had authoritarian regimes, and the way they function today is a social pact of how to keep the peace and democracy among them, and it has to do with economic arrangements. And so they're trying to reinvent themselves, but it's a very big dilemma, and of course this vicious cycle doesn't help. Venizelos, that's their finance minister, actually he wasn't the finance minister all the time. His appearance as finance minister was actually a signal that they're not going to follow the reforms through, because he is a much more political finance minister than his predecessor, who tried to follow reform packages to the letter. This one doesn't. He's aiming to be the next well, he's not going to get it because New Democracy is probably going to be in the next election, but he's probably going to replace Papandreou as the head of the socialists. So he's saying to them, don't blackmail us, we're blackmailing you. If we go, you go, right? So maybe we don't really have to work too hard. In the end, he was proven right, because the second bailout package was actually less dependent on the reforms. So there's an approving of the second bailout, but this comes with, and here's the big difference, PSI. PSI, public sector involvement. The Germans insist that bankers will take a loss, right? That's not only governments that are going to lose money, or there must be private creditors that should lose money, and that spooks the banks. That is first mentioned in April of 2011, but once it's given an official stamp in July, that's when the trickle turns into stampede. That's the beginning of the bank run in Europe, because investors are worried. We're going to take a loss. We don't need these banks. We don't need their stocks. So the stocks of European banks deteriorate. And then there's a banking crisis in Europe. In November 2011, we were very close to that Lehman moment, right? It was just very close to redo the whole global financial crisis all over again, this time when government reserves are depleted. That is, they can't do again TARP unless they indeed translate asset price inflation into goods and prices inflation. So that's when the ECB role, and this is where I'm going to skip to the ECB, because I know I'm short on time. You can all enjoy this later if you want. But before I go to the ECB, I want to show you, this is based on my previous book, where I calculated an index of compatibility of countries with being in the euro. It's based on optimum currency area, a theory that many economists have already discarded, saying it doesn't matter anymore. But as Marx suggests, when someone tells you that a good old theory isn't relevant anymore, that's when you should worry. And so you see Greece with the dotted line and the triangles is way off the pack, but the other countries that you have in trouble today, can I point? Yes, I can. So this line here, this is Portugal, which has high values and becoming worse. And this is Ireland here, okay? So they're all really not very qualified to be here. This is structural, because they're not open enough, because they're not synchronizing their business cycle and it's getting worse, because they have a different economic orientation. Here's just a very superficial kind of regression running. What I explain is external debt to GDP ratio, and these are just a bunch of dummy variables. And what you see is that in the euro area line here, clearly being in the euro area is a sure way to load up on debt. That is, if you are a member, you're 30 percentage points higher on your external debt. This is a debt club, okay? But it's of course those specific countries that did not fit in the club from the beginning. They simply transformed all their inability to compete in the club into debt. They financed that with debt, and it's shown very nicely. Okay, so the ECB is a lender of last resort. It stepped in to save the day. And it also is a bailouter in chief. We're thinking of bailouts in terms of packages agreed by EU finance ministers with conditions. That's true, but there's also a continuous bailing out operation on 3 channels that is going on, and not just recently. Okay, so the first is through collateral, right? The ECB accepted from the beginning, and this was legally stipulated, all kinds of collateral. It meant that Greek debt was all throughout considered as equal as German debt. So this meant that banks could buy cheap debt on the market, replace it for expensive debt in their collateral, that is, give the Greek debts, loading up the central bank with Greek debt, because the ECB actually motivated them to do this. In doing this, the ECB motivated banks to buy Greek debt. That was going from day one. That's not something new. Greece joined in 2001, joined the euro area, ever since. Another channel, how did Trichet, the governor, the president, central bank, the ECB said? He said, well, you know, if they're solvent, that works. Okay. There was a change in December. In December 2011, the ECB started to make distinctions. And I don't think it takes Greek debt anymore. Okay? And if it does, there's a huge haircut on it. And so the party is basically over on that channel. Okay? Second channel is what they call secondary market operation. Trichet explains this. And this is done technically in many central banks. They do this. I think the next slide. No, it's to ease the transmission, right? The transmission of the interest rate that the central bank wants to maintain. And so a lot of central banks are active in the secondary market and it's not considering bailing out government. But that is really a question of magnitude. At a certain level of activity, it becomes a bailout, okay? It certainly is a lender of last resort, and ever since May 2010, the program did not exist beforehand. This is where you can argue that they're violating the Maastricht Treaty, because they have begun a program, because of the Greek crisis, into buying more and more government debt to support. Now, they were saying that they must do this to support the banks, because the banks were so loaded on Greek and other debt that if they didn't do this, the bank would collapse. So this is a way to actually support the banks. But again, it's the same thing that you encourage the banks, therefore, to buy the government debt. So by June 2010, 2 months into the program, the amount of debt that the ECB was buying was 75 billion euros, mostly in the Greek debt. But it exploded in the fall, following the panic after the suggestion of PSI, of public sector involvement, and the panic going into Spanish and Italian banks. The ECB, become very active, and it jumps to 170 billion. In the fall, they're clearly bailing out Italy and Spain. They're not calling it this way, but that's what they're doing. Sorry. Can I use this? Snowball. Finally, third channel of bailout by the ECB is the system of credits between central banks in the system. They're giving each other credit. They have accounts with one another. They're part of the same bank. It's like one department in the bank giving money to another department. So that's just fine. But again, only as long as they're all in the euro area. Once one of them leaves the euro area, then that's no more internal bookkeeping. How much money is involved here? Big deal. Look at it. $450 billion. How much? Five. 450 billion euros, that the southern banks owe the northern banks in the euro system. That tells you why there is such a great panic and determination to prevent Greece from leaving. That will blow a huge hole in the ECB, at the heart of the monetary union. It's not easy to survive. Greece, when it goes out, will pull a chunk of the heart of the euro with it as it goes. Okay? So that's why they're so determined to prevent this from happening. And that's why they're throwing, as you said, the wrong instrument. They're throwing good money after bad because they're afraid of where this is going to lead. Okay? So there's this, of course, a lot of it involves German politics. How do you tell the people that this must be done? This is very, very unpleasant for many Germans. They thought they had an agreement. They thought they understood it. They, of course, violated it too, but that's a different story. So there's a growing politicization of the central bank and a growing disenchantment of the German public with the European Central Bank. But, never mind that, the Europeans, Tim Geithner visits the EU summit and he tells them, this is your Lehman moment. He does that in September, I think, September 2011. He tells them, yes, we want the ECB to be lender of last resort. Yes, we want the ECB to bail out governments. Why? We're broke. We have no money to save you. You want to save the global economy? It's here in Brussels that you're going to do this, and it's your mess, and you're going to solve this, right? So because it was realized what you need to do to save a country, and it's realized that they don't have the money to save Italy and Spain in the same way, that spreads panic, okay? And the PSI thing too, and Geithner, you've covered that. Okay, so we got a slowing down of lending activity in the fall, worsening situation in European finance, vicious cycle again. And in November, we got coordinated action by central banks around the world, not to protect currencies, to provide liquidity. And there's some relief when it is tried to be projected by Sarkozy and Merkel that PSI was only mentioned with regard to Greece, and it's not going to be a recurring thing, which means people are starting to prepare for other defaults. They're not only thinking of the Greek default, they're thinking whether this is going to be a rule that repeats itself, which is interesting as well. And then we go to the big plan of the unlimited. It's not really unlimited because of the distinction between the different collaterals, because of the margin calls you have on the collateral if it loses value. So it's not really unlimited in effect. As Mark already said, they're putting the money in the bank again, which this money doesn't really get to consumers or business people. It is recycled into the banking system in the end. So the point that I was trying to make to cap it is that the ECB, in fact, is a lender of last resort and is a bailouter. I think given the circumstances, it's a very good thing. All the while, I haven't been covering this in this presentation, all the while the European leaders have been building institutions. There's the EFSF, there's the ESM, and sometimes they're supposed to kick in. There's this new pact where they've all been writing into their laws that they're not allowed to have deficit, golden rules, that's what they call them, constitutional rules against deficits. I think my guess is that for as long as France and Germany want the system to survive, it will. There is a firewall is being built around those that are going to default, mostly Greece, probably Portugal too, so that the fire doesn't spread all the way into Frankfurt. With this distinction between the collateral, it's been a year or maybe 2 years almost that this thing is going on. It's plenty of time to banks to have sold enough Greek debt. The problem is with the ECB, it has acquired a lot of Greek debt in so doing, and there will be a lot of taxpayer money needed to recapitalize the ECB when they finally let Greece loose. Thank you very much.
I think we'll all gather around and we'll go back to where our nameplates are. And we have, I think, something like 20-25 minutes for discussion for those people. I'm sure that many of you are brimming with comments. Questions? Yes?
I'd like to know what will happen.
I'd like to know what will happen. I would think what to invest in would be, but, what will happen? So,
What does Marx say?
You mean what will happen in general or anything specific?
What will happen with the euro, with America in the eurozone in the nearest 5 years? What will happen with the economy? Will there be a deep depression or will there be some stability?
Well, my guess on it, and I've made a career out of saying that social scientists cannot predict anything, so I will now violate everything that I've ever said in print, is that if the Eurozone continues with the policy mix that it does, it will go into a very deep recession. and find it very difficult to get out of it. Greece will exit because they are insolvent, and you can't solve a solvency problem by just giving people more money. So the first part of the austerity story is true just for Greece. You can't cure debt with more debt. But the more that they cut their debt, the more indebted they get. So it's just not going to work. So they have to exit. This will be a shock, as well as the transmission mechanisms that were just mentioned. There's another one, which is those lovely little insurance policies called credit default swaps. Because as well as the ECB buying lots of that Greek debt, hedge funds have been buying lots of that Greek debt. And they have been making a bet that Greece is not going to be allowed to leave because it would be catastrophic. But just in case, they managed to get people to write insurance policies against the value of the debt that they've got. And just like happened with Lehman, this is an uncollateralized insurance market. Everyone's writing policies. No one has any collateral to back it up. So if any of that goes wrong, it's going to go wrong badly, and it's going to be centered in Europe. Ironically, so long as the Republicans don't win the next election, America will actually begin to recover. It's done the most to de-lever. It's done the most in terms of recovering its consumptive power, and it still has the deepest financial markets in the world's reserve asset. They have been downgraded from AAA. The yields went down. They didn't go up. So the debt sustainability argument only cuts into the effect that you have a kind of uniformity in the asset class, and we don't, because basically everyone will continue to hold T-bills because there's nothing else worth holding. So that gives the Americans a huge structural advantage. So America, yay, Europe, and run like hell from Britain.
What about Japan?
About Japan? I think you're the expert.
Japan is the oldest population in the world, and they save domestically. So they keep buying the bonds, and they keep living forever off the low interest payments, and they don't consume very much. So long as they don't all die at once of a virus, they're actually going to be okay for the next 10 to 15 years. But if you saw that green line on the graph I showed, I mean, that okay is a bad okay. But at the same time, I have this argument in the US all the time where people are like, well, look at Japan. And I say, well, look at Japan. Have you been there? The streets are clean, the trains run on time, no one's starving to death. If this is a 15-year recession, it's a pretty good 15-year recession. But part of that is because the income distribution is a lot better in Japan. So if you add those factors together, you can have 200% debt to GDP and actually look okay. Whereas you can be a country such as Ireland, which was one of the best in class, as you mentioned, 35% debt to GDP, budget balance, the whole lot. And if you allow your banks to lever up 4 times GDP and then they blow up and then you guarantee them, no amount of stupidity can save you from that.
Japan is not in such a big trouble if you focus on income per capita. Income per capita is not falling. It's just that the population is falling. And that's a major force for recession if you focus on GDP. Mm-hmm. But they are number 2 in the world after the United States in patents. They're a very innovative nation. So it's just a shrinking population. But otherwise, per capita, life is great. Well, more or less. For Europe, I think Germany and France will continue their partnership because the major fundamentals that drove them into building the European Union have not changed. It wasn't really about the Soviet Union. That was one explanation often offered, but it's a way to manage French decline and German ascent. Now, Germany does have a trajectory, a demographic downward trajectory further down the century. So they're not all that sanguine, and that's a good thing because it keeps them humble enough to cooperate with France. So they'll sort out the mess, but they'll have to say bye-bye to some of the countries that never had to be there. My guess, the good question, and I can also is gripping with this thing, is why was Greece allowed in to begin with? Yeah. That's the good question, and the answer, which is a bit speculative, I mean, I can't prove this, but in a Popperian way, until you refute me, this is the truth. I think that it was a good idea for France in order to delay reform, because France is like, it's a similar story of trying to protect state jobs, state companies, great involvement of the state in the economy, when they have to compete with Germany. So Greece is a first trench to protect Paris, and so they needed to have Greece. In fact, that's a story that recurs in Europe. France decides to hug Germany because it doesn't have another option, but that's kind of scary. So it piles up a lot of small countries with it in bed with Germany so that it doesn't feel alone there, okay? But these usually they underperform, and they get everyone into trouble because, they can't run themselves very well. So at some point, you discard them. You throw them away, you kick them out. That was common in the EMS or the... This time, discarding them is a lot more expensive. It's very expensive, and it was from a historic point of view, it's foolish, from a French point of view, to do this, to agree to this. But that's the way it is, and in 5 years' time, I think by then they can see it off. But it will require taxpayer money, and they'll have to face up to German voters, and they'll do that.
First this gentleman and then this lady. First you and then you.
Two questions. First question to Tal. How do you explain the fact that it is the ECB that does this job, and it takes like a so-called left approach than the political, like Angela Merkel? I mean, they still deny that. They don't deny, but they don't emphasize that the ECB is basically a lender of last resort, and the German finance minister is...
That's how they're getting away with it?
No, why? Why the political
Why are the bankers
leadership
being lefties?
is taking...
That's very simple. Because Trichet was never a banker. He was an officer in the French finance ministry. He was a close aide to presidents of France. He was then sent to be, in the 1990s, for a while, the president of the French central bank, so as to have everyone forget that he was never a banker, really. And then he was sent there. He is an Élysée person. He is not a banker. Even if he had, in his resume, a line saying that he, for a few years, was the head of the Banque de France, which, again, is often seen from the Élysée as just an extension of the foreign ministry. They're playing the game because they have to find fancy with Germany. But that's not the way France think of banks. They're always organs of the state. And if you think of what you've heard from Mark, it makes sense. If you end up bailing them out, better look at them as organs of the state from the beginning. And that's the French logic. So, and Trichet had in history, I mentioned that in the comments when Eichengreen was here, he was head of the Monetary Committee in 1992, when he booted out Italy of the system to preserve the Franco-German tie. He knows his politics. He's a politician, not a banker. And it was very clear to me, at least, that when he's at the head of the ECB will play as if it's run by the Ministry of Finance of France. So that's no surprise.
You have another question.
Yes, Mark, how do you explain the difference between the US and the European approach to the crisis? Why the Euro insists so strictly about the austerity issue? Is it, interests or ideas, or what do you think?
The $64,000 question. I would like to say that it's nothing more than an ideological bias plus the historical mismemory of German hyperinflation. But that's too simple. First of all, the Germans get their own story of hyperinflation wrong. They have to remember that it was a unique event that happened not just to Germany, but also to Hungary and to a bunch of other countries at the same time. It was a consequence of the end of the war and war financing and so on and so forth. And it really had very little to do with politicians running the printing presses in the way that we think about it today, particularly after the occupation by the French and so on and so forth. So you have to heavily discount this one. It's used, but it's not really true. Part of it's electoral politics. Basically, you have to sell to your public the fact that you are a transfer union, even if you pretend that you're not, and that your central bank may be a lender of last resort and a liquidity function. But that's not the whole lender of last resort story, in the sense that you're meant to be able to do the whole suite of operations, bond buying in the secondary market, overtly, so on and so forth, and having a euro bond and all that sort of stuff, which is still off the table. So I think a lot of it is essentially trying to get somebody else to pay. Right? So the Greeks blew up, the Greeks can pay for it. So the Americans had the similar problem with the banks, which is the banks blew up, let's make the banks pay for it. But the banks turned around and said, we don't have any money. How are you going to make us pay for it? So then you turn to the taxpayer, and the taxpayer pays for it. So in Europe, you don't really have that, because you don't have a unified political or fiscal system. So the Greeks have to pay for it, but the Greeks can't pay for it, so you squeeze them with austerity and you pretend that they're paying for it while you give them more and more liquidity, which will never solve the problem because it's ultimately solvency. So you can tell the story as ideological stupidity, or you can tell it as kicking the can down the road because you don't have a better option, and it's probably both.
There's a lady back there, yes, and then you afterwards.
Mark, could you speak some more about how we can get out of the situation?
No. I only do why we're in it. Well, it depends on who's the we, right? So, how do we get out of this? Really, how do we get out of this? And the question is, who's the we, right? So, first of all, well, we're sitting in Israel. You're not part of this. You are, but you're not, right? Yeah, you are, because we're all interconnected, right? And Asia's part of this, as I suggested, because China depends upon exports, and they export to the EU and the US. So in a sense, we're all interdependent in this. But the United States is actually kind of very slowly recovering. Now, the US has one huge micro-sociological advantage over Western European labour markets. In America, when you're unemployed, you think it's your fault. In Europe, when you're unemployed, you think it's the government's fault. Right? And that is a hugely important dynamic, which is why the United States can tolerate such very large hidden unemployment. But you have a long-term secular shift that's going on, particularly in the European economies, that they're going to really struggle to deal with, which is the dirty little secret of youth unemployment, which is really, really bad in Europe in comparison to the US, and it's not great in the US either. Manufacturing, high-end manufacturing, where the Germans make their money, the Swedes make their money, you can basically start in Finland and do a sort of a column that runs down through Sweden, goes over northern Germany, goes through the financial sector of southern Germany, and ends up in Alta Adige. That's hyper-productive, high-end, diversified quality manufacturing in Europe. They don't need workers. They need robots. Right? At the end of the day, you can make huge amounts of superabundant capital, and you can augment with more and more capital, but you don't need thousands and thousands of workers anymore. Well, no, in Greece what you can do is you can cut healthcare expenditures by 30%. That's equivalent to shooting 10% of the population. So you can do that. But you have to think creatively about it. And you can think about retraining, you can think about different modes of service provision. The Scandinavian economies are pretty good at absorbing that labour. But then you have a redistributive problem. So if you can generate a huge surplus, but it's politically possible to redistribute, you can have very high-paid elderly care nurses. That's Denmark. It kind of works, right? You can never pull that stuff in the US. Right? The idea that you'll pay 60% taxes so that you can pay somebody $20 an hour to work for the public, that's a neuralgia. That's never going to happen. But the United States makes up for it in another way. If you're unemployed, it's your fault and you just exit the labour market. So these long-term dynamics, demographic changes, etc., cost of healthcare, all of this is factoring in. So to go back to what Reuben was saying earlier, in a sense, yeah, we've been here before, we see the boom and bust, this time it's come home to us. Right? Dal then said it's different because look at this trajectory, we managed to sustain it. I think both of these things are true, but we have to go further. This crisis is a wake-up call for other things which are coming down the turnpike. When you go to college in the United States now, you can spend $50,000, get $50,000 in debt, go into not a very good college, and come out with that debt that is super senior debt. You can never repudiate it. It's like having half a mortgage before you're even 23 years old. Then you go into a labour market which is paying less and less by the hour to more and more flexible contracts. So what's the incentive to go to college? And also, if you're not generating high-skilled jobs, why do you need high skills? So you have a general skilled labour market which is very flexible but carries a high lot of hidden unemployment. That's not very good going forward, but at the same time the American banks are getting better. The balance sheet on this is incredibly complex. So how do we get out of this? I literally can't answer that because you know what? You solve one problem, another one's going to pop right up. And that's where we are.
Gentleman in the back.
Another question for Mark. I heard you were alluding somehow to maybe a different way banks of doing business. So maybe going back to focusing on consumers more, or is that something that might even happen, or?
Jamie Dimon, the big American banker from Morgan, has said that what we're now looking forward to is big box banking. And what he means by that is big box retailing. So just as the corner store was done in by the supermarket, so these huge outside of town developments where you sell televisions for $10 because you've got 20,000 of them in storage. Right? That's the model. So what is he talking about? Well, if you think about growth outside of the core countries, the estimates are there will be 3 times as many Brazilian multinationals as there are now. There will be 7 times as many Chinese multinationals as there are now. They're all actually going to need real commercial banking services. They're going to need underwriting of issues. They're going to need all the traditional things that banks do. So if you have a globally competitive bank, you can do those types of things. What you're not going to be able to do are all the leverage games and trading games that they've been doing for the past 15 to 20 years. That's done. So it's likely that you do get a transformation back to more commercialized banking, but it's not going to be 363 under the old model. It's going to be on a global scale. So that means that you're going to have very, very large international banks that are able to play this game. Now that's if Jamie's right. Because if I'm right, and basically China ends up slowing down and the whole Asian miracle proves to be less than miraculous because it's tied into growth in Europe in particular, and European growth really slows down, then that's probably not going to come online.
Maybe they will start consuming.
That's a problem. Absolutely.
Yes. Anybody else?
Can I contribute to this
Yes.
question? One of the reasons that you have bubbles is that you have too much money going around and not enough practical things to do with it. Okay, the question often is a supply side question. Why aren't there good enough things to do with it? Which then supply side economists say, all right, so free up your markets, innovation. But the thing is, in politics, is that society gets tired from reform. If you tell people that they have to be dynamic, that means they have to change their social fabric. And that takes time. It may take a generation sometime. And if finance accumulates surplus much faster than society is able to change its institutions, you get bubbles.
2 last questions, over here and over here, okay? Yes, you
So,
first.
if Turkey would be accepted in the past to the market, would it be like Greece, or would it be in a better situation?
It's not going to have a single currency with Europe. They have a customs union as is. The issue of accepting Turkey is about free labor mobility. Would you like the Turkish people moving freely in Europe? That's the main political issue, and that's why, because most Europeans object to it, this is not going to happen anytime soon, but it will happen eventually. I don't think they need to share currencies. There's plenty of countries in the EU that do not share the currency. That could work. I wouldn't recommend that they share the currency.
So it wouldn't be Greece. Turkey wouldn't be Greece. If they, in the past, if they had accepted Turkey, would it turn out as Greece or not?
Your question reminds me, my grandmother used to say about World War I that, if Austria was Hungary, so she ate Turkey and left Greece.
Well,
Okay. Over here, last question.
Yeah. You have kept the next World War out of your discussion, but it has already started. Can you comment on it?
Which one? Okay, where does it start?
It started already.
He means Iran.
Mm-hmm.
It is a Muslim war. It's not a Christian chivalry war. Then it goes step by step, and Iran is not going to stop.
I think you're probably right that Iran's not going to stop, but let me give you a hopeful way, a naive but hopeful one, and then a more cynical one. The naive but hopeful one is this. Countries that get nuclear weapons don't use them unless you're the United States. So you get them because then you don't get screwed with, because everyone knows you've got a nuke. That's the entire point of getting one. So the problem with Iran getting nuclear weapons is not the fact that they'll have them and they'll throw them around. If they did, the United States would turn them into a parking lot in 15 minutes, and they know that. The problem is that you don't get rid of them. They're a permanent part of the furniture once they've got them. That's the real problem. And that's a management problem rather than a World War problem. The World War problem is actually, however, the sad truth about Keynesianism. War's really good for righting the fiscal balance, because not only do you get a massive multiplier effect, you can engage in all sorts of nasty financial repression, where you can basically make your banks hold lots of government debt at really low interest rates, and then you can run a positive inflation. And all of the debt that we're worried about now, it'd be gone in 5 years.
Yeah, for as long as you live in a different continent and the war is in a different continent.
Which the Americans are very good at.
Called monetizing the debt. Well, look, thank you very much. Thank you for a wonderful evening. And